Hello agents, hello everyone. So today I just want to jump into like, what can you use to fund a fixed annuity to fund it? What premiums are allowed? How do they get there? Really quick, it's not a lot to go through. So let's just jump into this today. Funding a fixed annuity, premium types allowed. Here we go. Okay, so first we're going to talk about non-qualified annuity contracts can be funded. So this is after-tax money. So non-qualified and qualified, I'll go through that real quick. I've even had a CLU once call me, what's the difference again? If you don't work with this stuff every day, you might not be familiar with it. So non-qualified money is after-tax money. So you got a paycheck, you paid the tax, you put it in your checking account, that's after-tax money. So that's non-qualified, whereas the qualified money is any type of plan where you've taken a deduction, you haven't paid the tax on it, and it's going to be fully taxable at distribution down the end. So that's pensions, IRAs, Roth IRAs, stuff like that is all considered qualified money, whereas non-qualified money is more like cash and anything from your checking account, stuff like that. So let's jump into this non-qualified after tax first. So again, like the checking account. So if you have money you earned and it's in your checking account, you want to say send 20,000 to annuity, you can write a personal check, or if you're a business that wants to own it, a 503c or something, a 501c or something that wants to own it, you can write a personal check and send it up there. Cashier's checks are not really liked from the insurance companies. Sometimes they take it, but they want where'd the money come from, a letter from the bank explaining where the funds from to offset any money laundering issues there that they may have concerned with. Next, we have the via wiring instruction. So you can just get wiring instructions from any of these insurance companies, and it'll have direct wire transfer. And that's the quickest way. It takes about a day. Sometimes there's a fee from the company wiring the money or whatever, but that's a fast way to move money on a non-qualified, so wire transfer. 1035 tax-free exchange is when you move from, let's say you initially put, your 20,000 from your checking account. You've owned the annuity for your 3 years or whatever the term was, and now you want to move to a new annuity. Well, you use it. You don't take the money out because it'd be a taxable event on the gain. So you do a 1035 tax-free exchange from a carrier to carrier and replace one annuity with a new annuity. So that's called a 1035 tax-free exchange. And there's just a traditional non-qualified transfer. So if you don't want to write a check, or if you have a savings account at the bank, you can do a non-qualified transfer form, and that'll be sent to the bank and they can distribute the money that way. It's a little bit slower to do that, but it's a lot cleaner. To direct, you don't have to get involved a lot. The clients don't have to get involved a lot in that stuff. So those are the four main ways to fund a non-qualified annuity contract, premiums. So, and now how are these issued? So just traditional, it's just called non-qualified is one, and inherited non-qualified as another way they can be issued currently. So next, let's jump into the qualified annuities. I already explained that. That's pre-tax money. You haven't paid tax on this money. So that's via a direct rollover for carrier to carrier, bank to bank, wherever your money is in a qualified plan directly to the annuity company. So it's called a direct rollover of that money. A direct transfer, same exact thing, only it's transferring from one entity to the other. We have a wire transfer, the same as the wiring instructions above, and you can directly send the money via a wire to the insurance company. Next is a check from your checking account. This is like an indirect rollover. So let's say you had a pension or a qualified plan and you just liquidated it. You didn't know what you were going to do. The government gives you these 60-day window. Once a year, you can do this. So if for some reason, maybe it was a mistake, whatever, the money wound up in your checking account, but it's still qualified, you can write a check and send it in. And just as long as we have documentation of how that money moved and where it came from, you're fine with that. And these are issued as traditional IRAs. Oops. They're issued as inherited IRAs. You can get a Roth IRA, a Sep IRA, and any type of qualified retirement plan, a 401k, a pension, 403b. Not all companies will take this, and oftentimes there's a third-party administrator needed on the outside. For the most part, like 99% of the time. But there are some companies that will offer to do that other work too in their pension type side of their business. But that's basically a generic breakdown of how the money can be used. In case you didn't know, you could fund an annuity with an IRA, a brand new IRA if you needed it for your taxes or something. We can start those anywhere from, the very, very small side, $250. But most people start those with about $2,000 to $5,000. And then all the rest can be rolled over, transferred, all that good stuff. So what is it? This is what if What does the form, I don't know why I have what if does the form, but what does the form ask for, right? So it should say that. What does the form ask for? I don't know where my English came out here. So you're going to check the existing plan is going to be non-qualified, a traditional Roth. So here's like the form from the company and you check what you need. Where is it coming from? You can break it down if it's coming from annuity, life, a CD, a brokerage account, mutual fund, money market, or other. So that's where your money's coming from. This is the transfer form, right? And then you break down the types. You got the non-qualified, 1035 exchange, or your liquidation of a non-qualified account. We have, whoops, don't want to do that. We have our rollover here, direct rollover. And it's pretty cool. If you have qualified money, you're over 72 and a half, you can tell them how you want the RMD set out if you've already done it, or if you want it processed via the transfer. Not all companies are that way. Usually we do the RMDs prior to the transfer, but it is available. So fine tuning the transfer, especially if you're in a 30-day window. So we have all these different full transfer liquidation or partial. So if you want to do a partial 1035 exchange, or if you, let's say you have an annuity that's completely out of surrender, it's liquid, it's a walk away, but it's maybe earning 1.5%, but you have a couple 100,000 in it. You can move like say 150,000 out and leave the rest there if you needed it liquid. So this is the partial exchange. And then this part here is on the maturity date or immediately. So if it is a liquid account, you can just say, hey, move it immediately. But let's say you're in a 30-day window and you're in maturity and you know the 30-day window ends at September 15th. So you can type right in here, September 15th, you know, so they don't move the money early and you get hit with a surrender charge or something like that. And of course, they want the old contract. So you can just say you've enclosed it or it was destroyed, or you certify that it was destroyed or lost. And that's that for the, I hope that was simple enough for qualified, non-qualified money. End of my presentation there. If you have any questions on that or would like more information on how to do a direct rollover or 1035 exchange or how they work, give me a call right there at the 800-373-9697. Follow us on LinkedIn and YouTube for the most up-to-date information, and I hope you're all having a great week. Take care. Talk to you soon. Bye-bye.